Good morning and welcome to today's webcast, Not-for-Profit Tax Update for Winter 2020. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters from Los Adams, Pam Alexanderson, Tax Director, and Emina Cresswell, Senior Manager. And with that, I will turn it over to Emina to get us started.
Great, thank you, Emily. Well, good morning, everyone. A couple of things to talk about today with our agenda is W-2 1099 filing reminders, Form 8300 reporting. We'll then dig into some excess compensation. We'll talk briefly about the parking fringe benefit repeal, and then we'll take a deeper dive into the 990T UBI Siloing reporting, as well as a few updates with regards to Form 990PF and some other recent updates that we're encountering with the IRS and reporting requirements. With that, we'll first talk about W-2 and 1099 filing reminders. The due date for filing 2019 Form W-2 and related forms such as W-3 with the Social Security Administration is January 31st, 2020. This is whether you file using paper forms or electronically. An extension of time to file the W-2 is not automatic, so you may request a 30-day extension by completing application on Form 8809, and there's certain criteria that will need to apply. Additionally, you would use Form W-2 to report scholarship or fellowship grants, which are includable on the W-2 if payments are related to teaching, research, or other services required as a condition for receiving the qualified scholarships. Additionally, payments are subject to income tax withholding. However, taxability for Social Security, Medicare taxes depend on the nature of employment and the status of the organization. A few more reminders with regards to due dates to 1099 and miscellaneous, 1099 INT and 1099 DIV varies depending on the recipient and the filing methods. Form 1099 miscellaneous that reports rents, royalties, or other type of income. The reporting threshold is $600 or more. For royalties, it's $10 or more. Same for interest as well. So 1099 INTs is $10 threshold as well. The due date to the IRS is February 28th, unless e-filing, then the due date is March 31st. However, note that the due date to recipients is January 31st. Form 1099 miscellaneous, the reports non-employee compensation, so box 7, reporting threshold is a payment of $600 or more, and the due date to the IRS and the recipient is January 31st. So it mirrors essentially the Form W-2 filing requirements. Form 1099 and DIV report interest, ordinary, qualified, capital gain, and exempt interest dividends. The reporting threshold, as I previously mentioned, is a payment of $10 or more, but $600 in certain situations. Due date to the IRS is February 28th. Unless e-filing, then the due date is March 31st. Again, the due date to the recipient is January 31st. There may be different forms required for payments made to non-resident aliens, such as Form 1042 and 1042-S. So keep that in mind, as there are different requirements and due dates with regards to that, which we won't cover. A new form that the IRS has issued right now in just draft format is Form 1099 NEC, which is non-employee compensation reporting. It's intended to replace parts of the Form 1099 miscellaneous. This will be applicable for tax years beginning in January 2021, so for tax years 2020, and it will include non-employee compensation, so box 7, and sales of $5,000 or more of consumer products, so box 9. So this form is really intended to carve out the 1099 miscellaneous and make it a little bit more specific to non-employee compensation. Our next reminder is with regards to Form 8300. So what is this form and who must file? Each person engaged in a trade or business who receives more than $10,000 in cash in one transaction or in 2 or more related transactions. The form must be filed by the 15th day as of the date the cash was received. So this is actual true physical cash that is received. So let's say, for instance, you are an educational institution, so it's school, and a parent comes in and would like to give you more than $10,000 to pay for their student's tuition. This transaction would be reportable on this form, and you'd have to file this with the Internal Revenue Service at their Detroit Computing Center. So it's a different type of organization. So it's not like the Ogden or the other places where you would have to file your tax returns, and it must be kept for 5 years from the date it is filed. It is quite a comprehensive form and requires quite a bit more information than just their name and their address, but you'd have to disclose the amount, and it's a very comprehensive form, and many people tend to be more hesitant, but we are receiving quite a few questions from clients with regards to that particular form, and especially here in Washington State with marijuana, for instance, being legal, but there are some banking rules, so there's a lot of cash floating around in our region whereby some folks are utilizing actual cash to pay for transactions. All right. We'll move on to the next topic, which is with regards to IRS enforcements, which we're seeing quite a bit more activity from the IRS, whereby they're looking at employment tax compliance. They're looking at U.S. withholding as it relates to Form 1042 and 1042-S, which relates to non-resident alien payments. Also, with regards to proper addresses being used on all tax returns, there are sometimes inconsistencies whereby, for instance, the payroll tax return uses one address, but the Form 990 uses another address, and so the IRS typically then tends to update their records based upon the most recent form filed. And so you may get a notice saying, hey, we've changed your address to such and such. So being mindful when you're filing tax returns, regardless of what type of tax return you're filing, that the same address is being used consistently. And then, of course, worker compensation classification between Form 1099, so independent contractor versus W-2 employee, is also another item that the IRS is taking a closer look at as well. With that, another hot topic as well is the federal versus California employee classification. There was a recent case in California called the Dynamex case which went from a wage and hour-based issue to being an employment tax issue, whereby the case was then codified into Assembly Bill 5, which took effect this month. It makes it more difficult to treat workers as independent contractors for California purposes, which could be different from federal tax purposes. So states are something to also keep in mind as they may deviate, such as California as well, when you're classifying employees versus the independent contractors. So it has been a hot topic, and we are definitely seeing some notices and quite a bit of discussions, which then takes me to our polling question.
All right, our first polling question: have you received any IRS payroll notices due to a 1099 versus W-2 classification? And your options are yes, no, or I don't know. I'll give everyone a few moments to respond to our polls today. To participate, please click the button next to the answer you choose and hit submit. And if you have any difficulty seeing the polls, you might try refreshing your browser with F5. I'll give everyone about 10 more seconds here. And let's go ahead and take a look at the results. Emina, back to you.
Awesome, thank you. So there are a few, looks like about 6% of you have received some notices. Majority haven't, and then a few don't know. So that is pretty consistent, so good job. There are pretty regulations both from government, from IRS perspective, as well as state perspective to look at with regards to workers' classification. So it's always good to get a refresher and to reassess how you're properly classifying. All right, with that, we'll move on to excess compensation. Pam?
Okay, thanks, Emina. Hello, everyone. What I'm going to do is cover a few topics that I know that you have probably already heard from us about, but they are fairly complicated, and I don't think that it hurts to just take a few minutes and remind you about some of the more complicated pieces of excess compensation and then unrelated business income. So I'm going to start with excess compensation, which is governed by Internal Revenue Code Section 4960. There was IRS Notice 2019-09 that was released that went into quite a lot of detail about this new code section and the tax that's due from it. It is 92 pages long, which is why I think it's a really good refresher to start the year with. It does have a Q&A format to it, and there's about 39 Q&As that will take you through this notice. It defines what an applicable tax-exempt organization is. It tells us what excess remuneration is, talks about a covered employee, and then it also goes into the calculation for excess parachute payments. And then it finishes up by telling the taxpayer how to report and pay the tax. So there is a 21% excise tax due from the applicable tax-exempt organization, and it is due on those employees that are considered to be covered employees, and we're going to go over later what a covered employee is. But those covered employees would be paid in excess of $1 million by the filing organization as well as the related organization. So when you take the compensation paid by those two organizations, you add that up together, and if you're above $1 million, you're likely going to be subject to the 21% excise tax. It also includes something called an excess parachute payment. I'm not going to go into a lot of detail on the excess parachute payment. I haven't seen a lot of parachute payments with respect to clients that I work with. So I'm not going to go into a lot of detail about that, but I will talk a little bit about what that means. The excise tax applies to taxable income, and it starts with W-2 wages, and then it applies some inclusions and exclusions from there. So we'll go over what that means. We are in effect because it went into effect for tax years beginning after 12/31/17, but for those of you that are fiscal year filers, you always have to remember to use the W-2 information that falls in the calendar year that ends in your fiscal year. So in the graphic here, with the period that we might be in right now, if you have a fiscal year from 7/1/19 to 6/30/20, you're going to be using the 2019 Form W-2. All right. So what is remuneration? That's a new term that the IRS is using with respect to this excise tax. And it does start with wages that are subject to federal income tax withholding. So we again have a little graphic here that talks about some of the more common inclusions and exclusions, and I'll go over a few of these. It does exclude designated Roth contributions under Section 402AC, and it does include amounts required to be included in gross income under 457F. And 457F is important because you want to pay attention to the vesting schedule. So based on when the payments for 457F vest is when you would consider including them in gross income. In the question and answer portion of the notice 2019-09, if you look at question 12, it says that remuneration includes a parachute payment that is not an excess parachute payment, but does not include certain retirement benefit or director's fees. So in the graphic, we are excluding the excess parachute payment. But if you do have a parachute payment for a highly compensated individual in your organization, and it's not considered to be an excess parachute payment, it would be includable in gross income. Remuneration is treated as paid when there is no substantial risk of forfeiture. So again, if you're looking at those deferred compensation payments, there can no longer be any substantial risk of forfeiture for it to be considered remuneration. The notice also talks about payment for licensed medical and veterinarian services. That's really important in our tax-exempt sector because we obviously have a lot of healthcare organizations that are exempt, and when you're talking about physician salaries, some of those could definitely go above the $1 million mark. So it does not include licensed medical or veterinarian services. And then it also does not include amounts in Box 1 which are not considered to be wages under Internal Revenue Code Section 3401A. So we're not going to go into what 3401A says here, but if you are subject to the 4960 tax, I would encourage you to go look at that code section. And then generally, you can get to an amount taxable for 4960 purposes, but as I mentioned before, in a 92-page notice, we can't quite condense that into a single table, so if we don't talk about something here specifically, it's really important to go look at that notice. So in terms of who is liable for the tax, it is the common law employer that's liable for the tax, and the common law employer that will file Form 4720 and specifically Schedule N that's includable in Form 4720. So the common law employer, as determined for federal tax purposes, is the one that is going to be liable for the tax. And when an employer that is an applicable tax-exempt organization or a related organization pays a covered employee either that excess remuneration, so the amount above $1 million, or an excess parachute payment, each employer is actually going to be liable for the tax, but there is not going to be a separate 4720 filed for each individual employee. So this is an extremely complicated scenario. Notice 2019-09 outlines a 5-step process for the calculation, and if you do have multiple entities that are paying a single employee, and as a result of that adding those compensation payments together to get above the $1 million, I really encourage you to go look at that 5-step process to make sure that you're doing the calculation correctly and that each entity that is making those compensation payments are liable for the actual tax. The sole owner of a disregarded entity is actually treated as the common law employer. So multi-entity groups may have a 4720 to file. If you're a multi-entity group, you cannot consolidate the filing under a common paymaster for that. Estimated tax payments are not going to be required for this excise tax, and the 4720 has the same deadline as the 990, so it's due 4.5 months after year end. If you do need to extend that, you need to have a separate extension, so don't forget that. The extension for the 4720 can be filed via the Form 8868. Okay, so let's go to the next slide here. Under Code Section 4960 governing the excess compensation, 4960C2 defines a covered employee as any employee who is one of the applicable tax-exempt organization's 5 highest compensated employees for the taxable year, or who was a covered employee of the applicable tax-exempt organization or any predecessor for any preceding taxable year beginning after 12/31/2016. So you want to make sure if you are a predecessor organization that you understand who your, if you're a successor organization, that you understand who your covered employees were for your predecessor organization. But we are looking at any given year the 5 highest compensated employees. Once you are a covered employee, you're going to continue to be a covered employee for all subsequent tax years. So again, we're defining a covered employee, not necessarily someone that might be subject to the excise tax, but we have to go one step at a time, and the first step is to determine who your covered employee is. So there is no minimum dollar threshold to determine a covered employee. So if you're an organization that doesn't pay anybody over $1 million, which I suspect a lot of you on the webcast are, you still have to go through this process of determining who your covered employees are to know who they are this year, because that's going to carry forward into future years. Once a covered employee, always a covered employee. So they don't have to receive excess remuneration or get excess parachute payments or be highly compensated to be on the covered employee list. There is a limited exception that says that an applicable tax-exempt organization that pays at least 10% of the total remuneration paid by the applicable tax-exempt organization and all related organizations to that employee during the current year, the employee is not treated as one of the applicable tax-exempt organization's 5 highest compensated employees. So again, this is extremely complicated when we're talking about employees, and if you have multiple organizations with your related structure, it's really important to read through the notice to understand who your 5 covered employees are for that current year, because as we end this slide here, once a covered employee, always a covered employee. And the beginning that you're going to start tracking this for is tax years after 12/31/16. Okay, I'm going to switch gears here for a few minutes and talk about fringe benefits, which probably most of you are the most interested in. But if you remember back to a little over a year ago, we had 512A7 introduced, which increased the unrelated business taxable income for amounts paid or incurred for qualified transportation fringe benefits. Most frustrating with this particular passage was parking. So I think everybody is probably well aware of what we call the parking tax. And for those of you who have significant parking facilities, it was a major exercise to go through to figure out whether or not you were going to have to include your expenses for those parking lots on your 990T and actually pay tax on that. So the one great thing to start this year with is that with the Secure Act that was signed into law on December 20th, 2019, we actually have a repeal of the provision that classified qualified transportation benefits, qualified parking facilities, and then kind of the lesser known on-premises athletic facilities as unrelated business income for tax-exempt organizations. So that was, a lot of us were doing high fives in the office when we saw that that was signed into law, because the repeal is retroactive to the date of enactment. We are going to talk a little bit more about the potentially expedited process to request the refund. So what I want to share with you right now is we just need to stay tuned. If you are in a big rush to get your refund back, you can file an amended 990T. We are not necessarily recommending that organizations just right out of the gate do that. It might be an expensive process for you to file an amended 990T. So just stay tuned for what that expedited process is. There is a lot of work within the IRS to get something out to all of us as quickly as possible. So we'll go over, I think, at the very end what some of those options are. But one thing to really pay attention to is state conformity. And please understand, with the TCJA, not all states conform to the TCJA, and some states conformed 100% to the TCJA. So it's really important to pay attention based on the state that you're in and how you will or won't go about getting a refund from a state perspective. So, Emily?
Okay, our second polling question. Did you pay significant taxes related to the Qualified Transportation Fringe benefits? And your options are yes, no, or I can't remember. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. I'll give everyone about 10 or more so seconds to respond. And let's go ahead and take a look at the results. Pam, back to you.
Okay. So luckily, 70% of you actually didn't have to pay any tax related to that. So, you know, the repeal is kind of a non-issue for you, but 25% of the organizations did. And I know here at Moss Adams, we worked with a large number of organizations that had to pay a significant amount of tax. So even though we have the headache of going through the repeal, at least we have the option of actually going through because of the repeal and getting those funds back. This was definitely something that was really cumbersome for some organizations and definitely a waste of time. So for 25% of you, it's great news. For 70% of you, we're going to hope that this never comes back again. Okay, so now I'm going to switch gears again, and I'm going to go into a little bit more about unrelated business income and specifically the siloing. We are well into the midst of having to file the 990T with the separate Schedule M's to report all the different silos and UBI activities for all of our organizations. So we wanted to go through some reminders with respect to that. And then we're going to also talk a little bit about all the K-1 partnership interests that you might own and how you go about determining if you've got unrelated business income from a partnership. So again, just a little bit on the reminder side about UBI Siloing, that this is effective for tax years beginning after 12/31/17. We do have notice number 2018-67 that talks about how you can figure out if you have multiple activities that need to be reported separately. So I think all of us are aware about the 6-digit NAICS code that can be used to determine those silos. But you certainly need to also pay attention to debt finance property and whether that should be its own silo. If you have income from a controlled entity, rent, annuities, those sorts of things that would be considered unrelated business income, whether those should be reported separately. And then we're going to talk about the treatment of the K-1 investments. go over a little bit about the NOL rules just to give you a reminder, especially if you have NOLs from previous years that are still rolling forward. And then a note here about considering GILTI, which is the Global Intangible Low Tax Income rules. We are actually not going to go over GILTI in this presentation. Don't think we have enough time to do that. But just consider if you are subject to GILTI, please pay attention to those rules. We want to let you know that there are some temporary regulations in the works based on lots of comments received to this notice, and we are expecting those to be issued soon. Okay, so for UBI Siloing, again, just a little bit of a refresher. If you carry on more than one related business activity, you have to calculate your unrelated business taxable income separately for each activity. So if you just think about a normal business that files Form 1120, you are going to segregate those activities into silos, and you're going to report the income and the deductions with respect to each separate activity. You can no longer use the taxable income or taxable loss of one activity to offset the income from another activity. And then we'll go over the transition rules with respect to NOLs. So you calculate the unrelated taxable income for each activity. The UBTI for each activity cannot be less than 0. That's not to mean that you can't have an NOL for each separate activity. You can, you just cannot use that NOL to offset a separate activity. Once you have UBTI, then you get your specific deduction of $1,000 that's applied after you use your NOL. And then we all know it's effective currently. Okay, so under Notice 2018-67, for those NOLs that you have for fiscal years ending before 1/1/18, you know we had a 2-year carryback and a 20-year carry forward, and you are allowed to offset 100% of income until exhausted going forward. For NOLs that ended after 12/31/17, this is sort of the period we're in now, no carryback, an indefinite carryover, and again allowed to offset 100% of taxable income in the year used. But for NOLs beginning after 12/31/17, the difference here is that you still have the no carryback, you have the indefinite carry forward, but you're limited to 80% of taxable income in the year used. And that is similar, or the same, not similar, to for-profit organizations as well. They are also limited to 80% NOL usage, and those in our environment are definitely siloed. So we're going to go through an example here on activity bucketing. And again, just to refresh you so that because you may have some NOLs in this pre-2018 era that you're still exhausting and using going forward. But if you take the example here, we've got 4 different unrelated business activities, and in our current environment would need to be siloed. We've got net losses from 2 of those activities, and we have net income from 2 of those activities. The net income is going to be taxed at 21%. So for web advertising, on $235,000 of net income, there's a $49,350 tax bill. And from printing services, there's a $10,920 tax bill. For tax years after December 31st, 2017, if you add the $49,350 to the $10,920, we would have tax due of $60,270, and the NOL carry forward of $462,000 on the K-1 alternative investments would only be applied to future alternative investment income at 80%, whereas the $40,000 NOL net loss on rental income can only be applied to future rental income at 80%. So it's really important to take the time to know exactly what your income is, what the deductions are with specifically for that activity, and then make sure that you're tracking those NOLs specifically activity by activity on a go-forward basis, so that you are making sure those are in silos and not using those NOLs for a separate activity that's not related. Okay, Emily, we have another polling question.
Okay, our third polling question. How many separate UBI buckets do you have? And your options are 1, 2, 3, or more than 4. And for those of you that would like a copy of today's slide deck, you can download that now from the folder that says Slide Deck and Handouts to the right of the slide view. We will also be sending the slides via email after the webcast. We'll give everyone a few more seconds here. And let's go ahead and take a look at the results. Pam, back to you.
Okay, so how many separate UBI buckets do you have? 47% have 1, 17% have 2, 12% have 3, and then quite a lot of you have more than 4. So the majority of the people on the phone have actually more than 1. And again, sort of as like parking, this is a little bit of a exercise to make sure that you're able to track these the right way, and specifically tracking those NOLs the right way so that you don't lose them on a go-forward basis. So we recognize the challenges with respect to the activity siloing, and as you're working through your 990Ts and your Schedule Ms on those activity siloing, you can obviously reach out to any one of us if you have any questions or need any help with that. We do want to take just 1 minute here. We had a couple of questions. We're going to go ahead and maybe answer one of them right now, and then hopefully at the end we'll have time for some of the rest of them. So I believe that we've got one question about the 8,300. Emina, do you have that question?
Yes. So one of the questions that popped up was, does the 8,300 apply to donations? And the answer is no. The IRS specifically excluded in their instructions to indicate that it does not apply to donations. Now, who does it apply to when they say a person, for instance? It includes individuals, a company, a corporation, a partnership, association, a trust, an estate, and even an exempt organization, which also includes employee plans. So, and it is true physical cash. There are some exceptions and there are some caveats if you think that you're getting money and it might be suspicious activities, and there are certain transactions that do also have to be disclosed even if they're under $10,000 too. So there are some more complex rules with regards to this form, but it does pretty much apply to most organizations. For tax exempt, if it is related to a donation, then it does not apply. So that's some good news there. So that will hopefully ease some of your questions as well, and ease your mind that, no, you don't have to complete this form for everybody that you get $10,000 for. It also excludes personal checks as well.
Okay. Thank you, Emina. We had one other question that said, with respect to the covered employees, in a future year, if we have a different group of 5 highest, but the person who fell off the list is still an employee, now we would have more than 5 covered employees. So what you're actually doing is you're actually understanding who your bucket, I'm going to use the word bucket, but who your bucket of covered employees are, and you're doing that on an annual basis. So this year, if you take your top 5 highest paid, those are your 5 covered employees for this year. Next year, you might have a completely different list of your top 5 highest paid employees. So now you've got 10 covered employees with respect to the organization over the past 2 years. If you are subject to the 4960 excise tax on excess compensation, you're going to take your pool of your 10 covered employees over the last 2 years, and you're going to identify of those 10, was anybody subject to the 4960 excise tax compensation. So once you are a covered employee, you're always going to be a covered employee. It doesn't necessarily, you're not going to pay excise tax on 10 different people at a single time, but you have to take those 10 into account when you're determining who your covered employee list is, and then of those who might be subject to the 4960. Okay, we're going to keep going with the presentation, and then hopefully we'll end up with the ability to answer a few more questions at the end. So now I'm going to switch over to the investment side with respect to unrelated business income. And the IRS gave us notice 2018-67 talking about investments. And so here we have a graphic for you that on the top you've got a limited partnership, and as an exempt organization you might have a fractional interest in that limited partnership. But underneath that limited partnership, the partnership may actually have investments in an LLC. Here we've got a couple of different LLCs, and then we also have a couple of different real estate entities under that one. So what the IRS is telling us is, as an exempt organization, you cannot necessarily just look at the K1 partnership that you are invested in. You have to look at the underlying investments of the partnership to understand if you have multiple trade or businesses. And what the IRS says in determining whether a partnership conducts one or more trades or businesses that are unrelated with respect to the exempt organization, the partner, which is the exempt organization, has to look at the definition of what a trade or business is. So then you go into all of those trade or business rules that talk about the first 3 rules as with respect to what an unrelated business is, and then further underneath that, what is a specific trade or business? Is there a partner? Is there a profit motive in that particular trade or business? Are they only shooting off interest and dividends, things that wouldn't necessarily be subject to unrelated business income with respect to those rules? So it's really important, if you are invested in a partnership, that you first understand if there are any underlying investments in that partnership, and then whether or not those are multiple trades or businesses. So a little bit more specifically, we are waiting on proposed regulations that look more specifically at the requirements of the notice 2018-67. And pending publication of those proposed regulations, an exempt organization may apply an interim rule to aggregate its unrelated business taxable income from its interest in a single partnership with multiple trades or businesses, including trades or businesses conducted by the lower tier partnerships, which we just talked about, as long as the interest that the exempt organization directly holds in the partnership meets the requirements of what they're calling a de minimis test or a control test. So an exempt organization may aggregate all of its qualifying interests in a partnership and treat them as comprising a single trade or business for reporting purposes. But partnerships acquired before 8/21/2018 don't need to meet the de minimis or the control test. So hopefully a lot of you have, as you're looking at your K1 investments, hopefully a lot of you entered those partnership investments prior to 8/21/2018, and then you don't have to go through this de minimis or control test. If you have a partnership acquired before that date, 1 K1 equals 1 trade or business. So here I'm going to talk a little bit more about the de minimis rule and the control test. So a partnership will meet the de minimis test as long as it holds no more than a 2% profit interest and no more than a 2% capital interest in the partnership. So I did not say or, I said and. So both of those conditions must be in place when you're looking at the test for de minimis. You will meet the control test as long as it holds no more than 20% of the capital interest in the partnership and does not have control or influence over the partnership. So again, that's a two-pronged test that you have to look at. When you're looking at ownership interests, you're looking at the interests that are held by certain related parties, and those must be included when you're considering whether these ownership thresholds are met. So here on the slide we have a graphic that looks at the filing organization, and let's say the filing organization has a 1.5% interest in that partnership. But then there's a significant contributor to the filing organization that has a 1% interest. If you have a significant contributor, that person is considered to be a disqualified person. And for this partnership interim rule, you have to look at the ownership of your disqualified people and combine their ownership with your exempt organization ownership to determine if it's de minimis. You also have to look at any related organizations you have. So in this graphic here, we're then going to look at the fact that this organization has a supporting org who owns a 1% interest in this partnership as well. So if you take the 1.5% ownership interest for the filing org, the 1% interest for the significant contributor, and the 1% interest for the supporting organization, that is not de minimis because the total of those are all above 2%. So as you're going through this year and filing and looking at your ownership interests, please know that your tax preparers might be asking you to go back to your disqualified persons to ask them if they have ownership in the same partnerships. And it really is important to abide by that. There should be questionnaires that you can give your donors and your significant contributors or disqualified persons to gather that information. We realize that that's going to be probably a pretty touchy subject to go back to your disqualified persons and ask that question. But we do anticipate that this is going to be part of the proposed regulations that come out and therefore necessary to do. Okay. With that, I'm going to turn it back to Emina for a couple remaining slides.
Perfect, thank you. So as you all may have heard, we had some recent updates and bill signed into law in December right before the holidays that sort of gave us some presents and not some good news. So one of these might be good news, might not be good news for your private foundation. But the SECURE Act basically established an across-the-board 1.39% excise tax on net investment income as opposed to the two-tier tax. So you could have either been a 1% or 2%. And in order to qualify for the 1%, you essentially had to look at your qualifying distributions and if they equaled or exceeded a certain threshold, which was a computational driven 5-year average to assess whether you qualify for the 1% rate. And if you didn't, then you were a 2% rate. What the IRS has now done is they've enacted a new tax rate that goes into effect for taxable years beginning after 12/20/2019. So really, essentially, for next year, for 2020, is where this flat rate will apply for most organizations. However, being mindful of fiscal year ends too. So 1.39% is really where private foundations are now headed. Some other recent updates with regards to what is going on for this current filing season is that the IRS is changing their requirement to e-file Form 990 and 990-PFs. A few organizations were exempt from this, but they've tightened it up so that much more organizations are not required to electronically file their returns. So we just wanted to mention that you should consider electronically filing if you've not done so in the past. We also had the Taxpayer Certainty and Disaster Relief Act, which was also signed on 12/20/19 as well. And a couple notable items from this one in particular for organizations that support disaster relief especially. For individual taxpayers, it was removed at the adjusted gross income limit for cash gifts, which was 60%. To a public charity supporting disaster relief has now been completely removed. It includes eligible donations from 1/1/18 up through February 18, 2020. So it did go back into 2018, so there's a little prospective aspect to it. And in order to essentially remove this cash limit, the individuals who are filing have to make this election as part of their Form 1040. So if there are those of you who might be on the line who do disaster relief, it might be worthwhile noting to your donors, hey, that this has happened. The IRS is offering some relief, and you won't be subject to adjusted gross income limitations with regards to disaster. As I previously mentioned, the California Assembly Bill 5 was codified into Supreme Court as a California case, and so there's a three-prong assessment to determine if a worker is an employee or independent contractor, and it did go into effect as of January 1, 2020. Some other notable items that we are seeing right now, too, in addition to what we have on these slides, is we're seeing an increase of IRS notices that are completely unrelated to payroll, for example, but what we're seeing is levy notices when there have been no previous notices, for instance. We're also seeing an increased amount of, hey, you didn't file your tax return, but we clearly, have documentation that it was. In addition, we're also seeing clients getting refunds that were unexpected, or when we had indicated, hey, please apply our overpayment to next year, but then the IRS is issuing them a check. So we're seeing quite a bit of activity from just an IRS notice perspective, not just as a firm, but other firms are seeing it too for their clients. And the majority of that was related to just the IRS getting so much more 990Ts with regards to the fringe benefits, but also various other reasons that their system is glitching out. So you might be seeing notices that just absolutely sometimes make no sense, but we are just seeing a large chunk. So please reach out to your tax advisors if you have questions, if you're seeing these notices, and we're happy to help out as well. So I did notice that was one of our Q&A questions as well, as where someone did receive a refund already, but they didn't actually apply for it or requested it to be refunded. So that could be what is happening, as we are seeing it with other clients as well. With that, we will then take it to our last question.
All right, our final polling question. If your organization is a private foundation, which tax rate was it usually at? And your options are 1, 2, or not applicable. And once you have completed all CPE requirements, you will be able to download a PDF of your CPE certificate from the CPE progress window to the right of the slide view. Give everyone some time to make a selection. And let's go ahead and take a look at the results. And Emina, I'll turn it over to you for any last comments before we get into the Q&A.
Sounds good. So it looks like about 7% were at the 1% rate, and about 5.6% were at the 2% rate, and then a majority did not apply. So for those that are 2%, yay, good news, lower tax rates. For those at 1%, bummer. So unfortunately, that tax rate just increased just a smidge more. So thanks so much. We'll just open it up for some more questions then at this time.
All right. Thank you. If you have a question for either of our presenters today, you may submit that in the Q&A window right underneath the slide view. And let's see what we have here. Can we file the Form 4720 to pay excess compensation tax with our 990 filing, or does it have to be separate?
It does have to be separate, as those are actually paper filed. There was some confusion at the initial start where how you make the payment, whether it's part of your 990T or if there's a separate filing, but it is a separate filing, Form 4720, and those are paper filed, so it does have to be separate. Now, you can certainly prepare it at around the same time, as typically you do have compensation information that might be applicable for the same time frame.
Thank you. And is there any indication as to how the IRS will allow us to recoup tax paid for disallowed fringe benefits?
So at this point in time, we're looking at guidance that the IRS is actually looking at doing a streamlined process. So they are. So at this point in time, we're holding off on filing amended returns, as the IRS might get overwhelmed, and it could slow down the process, especially if they come out with a streamlined process. What some agents are considering is perhaps you could call the IRS if you've already paid estimates for tax year 2019 with regards to the transportation fringes, and then have it be moved to 2018 tax year. So that way you only have to amend the 2018 tax return versus filing a 2019. Now, that's, of course, assuming that the only 990T activity that was previously reported, of course, relates to just the qualified transportation fringes. Another suggestion what the IRS is also kind of thinking about and what kind of got thrown out is Form 4466, which is a creek refund form that is usually due by the original due date of the return. It does not have an extension, so it does have to be filed pretty quickly if that is an available option. At this point in time, the IRS did not indicate if that is the route they're going to go or what they're thinking of doing at this point in time, but those are just a couple options that have been suggested to the IRS. Now we'll await further information at this point in time and provide more insight once we do have that as well. Okay, next question.
Thank you. We have time for a couple more. Are 457B payments required to be included in remuneration and calculating excess compensation?
Okay. So payments from most retirement plans, such as qualified plans and 403B annuities and plans, are not included. But when you're looking at 457B, if it's a non-governmental 457B plan, you would need to include those payments in your calculation of remuneration. And, you know, as you're talking about deferred compensation payments, those can take a lot of different forms. They can be in the form of life insurance, just all kinds of things. So I really encourage you all to go look at the Q&A for that notice, because it does go into a pretty good detail with respect to those different types of deferred comp plans and what could be included and what shouldn't be included.
Thank you. And we can probably squeeze one more question in. For the partnership's interim rule, what do we do if the K-1 does not show the amount of our partnership or capital interest?
Okay. So for your K-1s, one of the things that we have noticed in practice here is that there are a lot of practitioners out there that really did not digest all of the elements of the Tax Cuts and Jobs Act and did not do a very good job with respect to all the disclosures that are actually required on the K-1s. So if you did not get a disclosure, whether it's related to your partnership or capital interest or anything else for that matter, it's really important to go back to the preparer of that K-1 and ask them for that information. You do have to do the due diligence, and that is on you to do that. If you can't get it, then you can't get it, and you might have to go off of estimates from prior years based on, and then factor in your income and distributions and that sort of thing. But it's really important to do the due diligence to go back to the preparer.
All right, thank you. And that is just about all we have time for questions today. We did have a lot of questions come in that we didn't have a chance to answer, and we will do our best to follow up with you after the presentation. If anything else comes up, you can reach out directly to Pam or Emina. And thank you, Pam and Emina, for a great presentation today. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy of your CPE certificate will be emailed within 3 weeks should you have any difficulty downloading it now. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.